This third presentation on the series of retail brokers. So in the previous videos, we've looked at the concept of stop hunting. We know that it is a thing, but it's not the retail brokers doing it. We then looked at intraday volatility and changing market conditions. We looked at how this is basically directly correlated to how random you find the market. So if you're really finding the market's totally random, then it probably means you're not even paying any attention to what's going on in the news, what's going on in the news feeds, or you're having trouble interpreting that information. The more tuned into that stuff you are, the less random you're going to find the market conditions to be, and the better trades you will be picking, and of course the more consistent profits you'll be making. Now the third concept we're going to look at is something called B-booking. Now B-booking, it's going to be a very short video. It's a very basic concept, but not many retail traders are aware of its existence. So what is B-booking? Well, when you open a broker, particularly a retail broker, they have two distinct types of clients. Okay, the A-book and the B-book. Now, the A-book is all the clients that make money and basically get passed straight through to the real market. So basically, when they place a trade, it goes onto the market. The B-book is basically in existence for the retail traders that lose money. Now, why have an A-book and a B-book? That's the question. Well, the answer to the question is the fact is 95% of retail traders lose money, probably more than that. Okay, over a 6-month period, most of them will empty their accounts and lose all their money to the markets by making bad trading decisions or just not knowing what they're doing, basically. Okay, so if you're a broker, you've got two options. You can either make money on the commissions and the spread, which is how most brokers make their money, or you can make money on the commissions and the spread, and when that trader loses that money, you can make sure that that money goes into your pocket rather than the market. Okay. Now there is a certain element of risk for a broker because the broker is basically taking the other side of the trade. So that if the trader wins or if the market goes heavily in the trader's favour, the retail broker suffers basically big style because they have to then cover that cost because they've taken the other side rather than passing it on to the market. So it's fairly high risk strategy. And at the beginning of 2015, retail brokers found this out to their demise. Lots of big retail brokers went under when the SNB removed their floor on the Euro-Swiss currency pair. Lots of retail traders had major gains, and because the retail broker was covering this and it wasn't passing it on to the real market, basically it forced them to go bankrupt. So in the short term or overall in general, retail brokers make a lot of money by B-booking their clients because the client's going to lose the money anyway, whoever it goes. So they just think, you know what, we'll cover it and it'll go into our pockets. So it's not thieving, it's not theft, it's not unethical, okay? It's basically just taking advantage of the fact that retail traders are probably going to lose money. If you're a retail trader and you make money, all that's going to happen on the B-book is that you're going to cost the broker money, okay? And the broker's not going to want to have you on that B-book if you're costing it money over a sustained period of time. So a B-book, there's nothing really, I mean, some people might have moral objections towards it, but ultimately there's nothing illegal about it. It's basically how the whole broker, and particularly retail brokers, works on the back end. Not many retail traders know about it, but that's basically how it operates. And again, like I said, there's nothing underhand about it. They're not trying to be sneaky, they're not trying to hide that fact. But that's just how it works. And if you think about it, if a retail trader is going to lose all their money because of bad trading decisions, then of course it makes more sense to have it in the broker's pocket than it does to go straight into the market. So of course the broker has to take a big risk, and it does take risks when it does a B-book, but generally it will make quite a lot of money, extra income from the concept of B-booking. And this is basically, you might have heard little rumours, you might have heard people kind of say, the broker's on the other side of the trade, or some kind of conspiracy theory about traders trading opposite the retail trader. Well, there is some truth to it, except that the broker isn't exactly trading directly against you. They're just B-booking you. So basically, they're creating a false market environment that's a direct replica of the actual market. So you're getting exactly the same prices, exactly the same conditions. But when you lose your money, if that's something that happens, instead of it going to the market,